European markets tumbled on Monday, April 7, 2025, as a wave of risk aversion swept across the globe. The catalyst? US President Trump's unexpected announcement of new tariffs on a wide range of goods from major trading partners. The pan-European Stoxx 600 index plunged by a significant 6% in early trading, reflecting the depth of investor concern. This sharp decline underscored the interconnectedness of global markets and the potential for protectionist policies to disrupt economic stability. Among the hardest hit was Germany's DAX index, a bellwether for European economic health. The index plummeted by over 9.5% shortly after the opening bell, highlighting Germany's vulnerability to trade tensions. As a global export powerhouse, Germany relies heavily on open trade and faces significant risks if trade barriers rise. The automotive and manufacturing sectors, key pillars of the German economy, braced for impact as the tariffs threatened to disrupt supply chains and dampen global demand. The scale of the market downturn drew uneasy comparisons to previous periods of global uncertainty. The Stoxx 600's 8.4% decline the previous week marked its worst performance in 5 years, a stark reminder of the market's susceptibility to geopolitical shocks. The last time the index experienced such volatility was during the onset of the COVID-19 pandemic in 2020, a period of unprecedented economic and social disruption. The parallels between the current situation and the early days of the pandemic fueled anxiety among investors. While the nature of the crisis differed, both events shared a common thread: the potential for a prolonged period of economic instability. The 2020 pandemic demonstrated the speed at which a global crisis could derail markets and upend established economic order. The current tariff dispute, while less immediate in its impact, raised similar concerns about the fragility of global trade and the interconnectedness of global markets. President Trump's tariff announcement sent shockwaves through the global trading system. The tariffs, which targeted a broad range of imports from key US trading partners, caught many investors off guard with their breadth and scope. While Trump had long advocated for protectionist trade policies, the latest round of tariffs represented a significant escalation in his rhetoric and actions. The tariffs, which ranged from 34% to 49%, targeted countries like China, Vietnam, Cambodia, and Sri Lanka. The administration argued that these tariffs were necessary to protect American jobs and address unfair trade practices. However, critics argued that they would harm American consumers, disrupt global supply chains, and lead to retaliatory measures from affected countries. The tariffs marked a significant departure from decades of trade liberalization and raised concerns about a looming trade war. Section 4. Trade War. Fears grip markets worldwide. The prospect of a global trade war sent ripples of fear through markets worldwide. China, the world's second-largest economy and a primary target of the US tariffs, wasted no time in announcing retaliatory measures. Beijing unveiled tariffs of 34% on a range of US goods, signaling its willingness to engage in a tit-for-tat trade battle. The European Union, another major trading bloc, also threatened countermeasures if negotiations with the US failed to yield a resolution. The interconnected nature of global trade meant that the impact of the tariffs extended far beyond the US and its immediate trading partners. Asian markets, heavily reliant on international trade, braced for a potential slowdown in economic activity. Countries like Vietnam, with its export-oriented manufacturing sector, faced significant headwinds as tariffs threatened to disrupt supply chains and dampen global demand. The escalating trade tensions raised fears of a domino effect, with each round of tariffs potentially triggering further retaliation and pushing the global economy closer to a trade war. Section 5. Safe havens beckon as uncertainty reigns. Amid the market turmoil, investors sought refuge in safe haven assets, traditional shelters during times of economic uncertainty. The Japanese yen, a perennial favorite among risk-averse investors, strengthened against the US dollar as traders flocked to the perceived safety of the Japanese currency. Bonds, another safe haven asset class, also saw increased demand, pushing yields lower as investors sought stability in government debt. Analysts pointed to the yen's historical resilience during periods of geopolitical tension and economic slowdown. As the trade war fears intensified, the yen emerged as a prime candidate for investors seeking to hedge against market volatility and a potential US recession. The flight to safety underscored the depth of investor concern and highlighted the potential for the trade dispute to have far-reaching economic consequences.